I was just working away yesterday when I glanced up and saw that mortgage bonds were in the green 30 basis points. I was like, huh? What happened? We weren't expecting any data or market moving news on Thursday. I opened Instagram and whoa, everyone was freaking out about Trump's announcement that he was going to direct the government to purchase $200 billion in mortgage backed securities. This is a form of quantitative easing, and it's the other, less known lever that the Fed has to pull to stimulate the economy. Let's get you up to speed on the market sentiment today, including what the market isn't really reacting to at all. So, from a surface level, let's look at this. Trump wants lower interest rates and claims this plan will drive mortgage rates down, helping with affordability through lower mortgage payments. Makes sense. His critics say lower rates will increase demand and the inventory doesn't exist to support that demand, so affordability will actually suffer because lower interest rates, more buyers, less inventory, prices go up. I actually talked a lot about that on yesterday's webinar. Not Trump, I'm not psychic, I didn't know he was going to say that, but the inverse impact of lower interest rates on affordability. Trump's supporters were quick to respond to the critics that home values going up is actually great news for the many Americans who own homes and will see their equity positions further improve. Never mind, that wasn't what he said his goal was with lowering interest rates. He said his goal was affordability. How this all actually works, instead of getting political, in case you aren't familiar with quantitative easing. When the demand for mortgage bonds increases, the price of mortgage bonds also increases. This causes yields to fall, which is what brings down mortgage interest rates. Quantitative easing isn't typically focused just solely on mortgage bonds, though. QE, quantitative easing, is when the central bank buys large amounts of treasuries, including government bonds, as well as other financial assets, to inject money into the economy and lower long-term rates. Most are familiar with how the Fed lowers short-term rates by cutting their federal funds rate. This is their other lever, and it's how they make an impact on long-term borrowing costs like mortgage interest rates. It's typically done when cuts to the federal funds rate are not enough to stimulate the economy. It's typically done in times of crisis because it has major risks and implications for inflation. We saw an immediate tightening on mortgage-backed security spreads, which is why we were up on mortgage bonds right away in response. But the impact is already fading as I'm recording this midday Friday, and it might be because even if mortgage bond purchases tighten mortgage-backed security spreads initially, it doesn't guarantee large moves in the underlying treasury yields or long-term rates for all borrowers. The spreads that we always discuss here, you can reference a previous vlog, those still matter. But guess what, guys? There was big news that we were expecting today. It's a jobs day. Trump kind of took the wind out of the jobs data sails with his announcement yesterday, but we did get a report this morning with new numbers. Today's jobs report showed only 50,000 jobs added in December, and the market was expecting more, especially with holidays. However, the unemployment rate ticked down to 4.4%, which could also be why we're giving up some of our gains from yesterday. I'll explain. This complicates a narrative because while 50,000 jobs added is the slowest pace we've seen in a while, if unemployment rates are improving, maybe the jobs market is okay. Here's the deal. To keep it very simple, weak hiring, only 50,000 jobs added, would actually push the Fed towards rate cuts. But low unemployment indicates a labor market that's actually tight, which means the Fed should hold steady against inflation, which is still a real concern. That weird combo of data released this morning is probably why the market didn't give much of a reaction at all. It didn't know which part to react to. And rates remain sticky. This is why 2026 is expected to be a transition year, not the year of free falling interest rates and frenzied competition. It could happen, but every time we see rates improve, every attempt they've made at coming down in a big way, they've been quickly checked back to reality by the market. I will tell you that when rates move like they did yesterday, we immediately see a pickup in activity. Mortgage applications immediately jump. More buyers shop, more buyers lock when they know that the markets are hinting at cheaper money. It's an instant reaction. I did a webinar this week for buyers on how to take advantage of the window we're seeing right now instead of waiting on hypotheticals. If you missed it, I'd recommend watching it. I'd recommend sharing it with people you care about. Headlines like a $200 billion mortgage-backed security purchase or directive create perceived opportunity. But what we really need if we're shopping in this market is clarity on our strategy. I'm on a mission in 2026, you guys, that no first-time home buyer gets left behind. That if you wanted to buy in the near future, you take advantage of the window this market is providing you. I believe this will be the last best entry point in the market for quite some time, and I don't want anyone to miss it.